All right, so we're diving into some serious financial territory today. We're tackling 20 common money mistakes, all pulled from this guide you've probably seen.
Oh yeah, this one's making the rounds.
It is, and it's packed with good stuff.
For sure.
So consider this deep dive your cheat sheet, because sometimes just knowing what not to do can be a huge advantage.
Totally. And it's fascinating how many of these aren't like some complex Wall Street shenanigans. They're everyday habits that can really mess with your finances if you're not careful.
Exactly. Like, who has an impulse, bought something, and regretted it later?
Guilty as charged.
Right. But okay, enough confessions. Let's get down to business. Mistake number 1. Ignoring the basics of budgeting.
Ugh, budgeting doesn't exactly scream excitement, does it?
I know. Spreadsheets aren't exactly a party. But
Hold on, I've got an analogy for you.
okay, hit me.
Would you ever, and I mean ever, set off on a road trip with absolutely zero idea where you're headed?
Probably not the smartest move.
Exactly. A budget is like your financial GPS. Even if it's just a quick peek at your spending every week, that awareness makes a huge difference.
Right. It's about knowing where you stand so you're not swerving all over the financial road.
Precisely.
And speaking of veering off course, mistake number 2 is living beyond your means. It's easy to fall into that comparison trap,
Oh, the dreaded keeping up with the Joneses syndrome.
It's a real thing. But
It's a recipe for disaster. That kind of thinking can lead to a mountain of debt faster than you can say new car.
nobody wants that.
The real power move is living below your means and investing the difference. That's how you build real wealth.
Okay, so imagine this. You're cruising along, feeling pretty good about your finances, and then bam, life throws a curveball.
Oh no, what happened?
Unexpected medical bill. Sudden job loss. That's where mistake number 3, not having an emergency fund, can really sting.
It's like not having insurance on your financial well-being. Aim for 3 to 6 months of living expenses tucked away.
So you're not scrambling when those unexpected costs hit.
Exactly. You might not need it today or tomorrow, but that peace of mind, priceless.
It really is. That feeling of security can be a game changer, especially when things get unpredictable. All right, now let's shift gears and talk long-term retirement savings.
Ah, retirement, the golden years.
It's easy to push it off when you're younger, but
Time is your best friend when it comes to investing. Compounding is like this magical snowball effect. The earlier you start, even with small amounts, the bigger that snowball grows over time.
let me paint a picture. Imagine 2 people both investing $100 a month. One starts at 25, the other at 35.
Okay, I'm following.
By retirement, that early bird could have significantly more, all thanks to the magic of compounding. It's like getting a head start in the financial marathon.
You're not kidding.
Now, I know for some people, the whole idea of investing can be pretty intimidating.
For sure, it can seem like this big, scary world.
Right. And that leads us to mistake number 5. Avoiding investments altogether. Keeping your money in a basic savings account feels safe, but
Inflation is silently eating away at your purchasing power. It's like running on a treadmill. You're putting in the effort, but not really getting anywhere.
so your money's just sitting there, losing value over time.
Basically. Investing, on the other hand, gives your money the potential to grow faster than inflation, so you're actually building wealth over the long term.
Okay, but what about the stock market? It can feel like a gamble sometimes,
It definitely has its ups and downs.
and that can lead to mistake number 6. Overconfidence in stock picking. It's tempting to think you can beat the market, but
Even professionals struggle with that. Trying to time the market perfectly or pick individual stocks is risky business.
it's like trying to predict the weather months in advance, right?
Exactly. It's unpredictable.
So what's a more sensible approach?
Well, consider index funds.
Okay, tell me more about those.
They track a specific market index, giving you built-in diversification and usually aligning with overall market performance.
So less stress and potentially better returns.
That's the idea.
Sounds like a solid strategy.
It's worth exploring, for sure.
And speaking of diversification, that brings us to mistake number 7. Neglecting it entirely.
The classic don't put all your eggs in one basket scenario.
Exactly.
Diversifying across different asset classes like stocks, bonds, maybe even real estate helps protect your portfolio.
So if one area takes a hit,
The others can help balance things out. It's like having a financial shock absorber.
great analogy. Now, even with a diversified portfolio, you gotta watch out for those sneaky fees.
Oh yeah, those can be a real drag.
Mistake number 8 is high investment fees. They might seem small, but over decades.
They can seriously eat into your returns.
Give me an example.
Say you invest $10,000 and it grows at 7% annually for 30 years.
Okay, decent growth.
You're looking at over $76,000, but a 1% annual fee. That could shrink it to $60,000.
Whoa, that's over $16,000 lost to fees.
It adds up.
It really highlights why choosing low-fee investment options is so important.
Absolutely. Every penny counts.
All right, speaking of things that can drain your returns, let's talk about mistake number 9. Market timing. Trying to predict those perfect buy or sell moments is...
It's a recipe for stress and potential losses. It's like trying to catch a falling knife.
Ouch, yeah, not a good visual.
Market timing often leads to emotional decisions, which can completely derail your financial plan.
So instead of trying to outsmart the market, what's a better strategy?
Focus on the long game. Investing is a marathon, not a sprint. Ride out those market fluctuations. Stick to your plan.
It's about patience, not panic.
Exactly.
Now, we talked about diversifying, but what about rebalancing your portfolio?
Ah, yes, that's mistake number 10, and it's often overlooked.
It's easy to set it and forget it, right?
Right. But as markets shift, your initial asset allocation can drift.
So how often should we be checking in and rebalancing?
At least annually. Think of it as a financial tune-up.
I like that. Keeps things running smoothly.
That's the goal. Now, this next one is a real head-scratcher for me.
Oh, late on me.
Ignoring employer matches for retirement plans, it's like leaving free money on the table.
Seriously, if your employer offers a 401k match, for example,
take full advantage. It's a guaranteed return on your investment right off the bat.
Makes sense. Okay, let's touch on a topic that can be a little intimidating for some. Tax efficiency.
Yeah, taxes aren't exactly a fun conversation.
True. But mistake number 12 is neglecting tax efficiency.
It's about understanding how different investment accounts are taxed and strategically placing your investments to minimize your tax burden.
So you're basically playing the tax game to your advantage.
You got it. Tax-advantaged accounts like IRAs can help you keep more of your hard-earned money.
Smart move. Now, I know insurance isn't the most exciting topic, but it's crucial.
Absolutely, we can't overlook it.
Mistake number 13, inadequate insurance. It's easy to think it won't happen to me, but...
Life is full of surprises, and not all of them are good. Having the right insurance, health, life, disability is like a safety net.
Imagine facing those medical bills after an accident or illness without it.
It could be financially devastating.
Insurance can literally be the difference between financial stability and disaster.
It's about protecting yourself and your loved ones from those unexpected financial blows.
Speaking of protecting loved ones, let's talk about estate planning. Mistake number 14, skipping it all together. It's not just for the wealthy.
It's about having a plan in place for your assets and making sure your wishes are carried out.
Will designated beneficiaries, these things, can make it so much easier for your family if something were to happen.
It's a gift of peace of mind, really.
Okay, let's shift gears a bit and dive into some common mindset mistakes. First up, overusing loans.
Oh boy, that can be a slippery slope.
Yeah.
Payday loans, excessive credit card debt, taking on too much car debt. It's a recipe for trouble.
It's so easy to fall into that trap, especially when lenders make it seem so easy to get quick cash.
But those high interest rates can bury you.
The key is to prioritize paying down debt.
Right, absolutely. And even more importantly, focus on living within your means so you avoid accumulating unnecessary debt in the first place.
Solid advice. Now, remember how we talked about inflation earlier? Well, mistake number 16 is underestimating its impact.
Inflation is sneaky like that.
Yeah.
It's those gradual price increases that we don't always notice right away.
Right, but they add up over time.
Big time. If your savings and investments aren't keeping pace, your purchasing power takes a hit.
It's like watching your money slowly shrink.
Exactly. That's why it's crucial to choose investments that have the potential to outpace inflation, helping you maintain and grow your wealth.
Makes sense. Okay, picture this.
Mhm.
The market takes a nosedive, and you panic, selling everything to avoid further losses.
Oh no.
That, my friends, is emotional investing mistake number 17.
Fear and greed are powerful forces in investing, often leading us to make impulsive decisions.
It's like hitting the eject button at the first sign of turbulence.
Instead, take a deep breath, remember that volatility is normal, and stick to your long-term plan.
It's about discipline, not impulsivity.
You got it.
Now, mistake number 18 might seem obvious, but it's more common than you'd think. having no financial goals.
Without goals, it's easy to drift aimlessly and lose sight of what you're working towards.
It's like setting off on a journey with no destination in mind. You might enjoy the ride, but you'll likely end up somewhere you didn't intend to be.
Financial goals provide direction and purpose.
So whether it's saving for a down payment, planning for retirement, or funding that dream vacation, those goals help you stay focused and motivated.
They give your financial decisions a sense of purpose. Now, when it comes to investing, it's crucial to know your comfort level with risk.
Right, some people are more risk averse than others.
Absolutely. And that leads us to mistake number 19, ignoring your risk tolerance.
Some people are naturally more cautious, while others are comfortable taking on more risk for potentially higher returns.
There's no right or wrong answer. It's about finding what aligns with your personality and your financial goals.
So if your investments are too conservative,
You might miss out on growth opportunities.
but if they're too risky,
You could end up stressed out and making impulsive decisions.
it's about finding that sweet spot where you can sleep soundly at night, knowing your investments are aligned with your comfort zone.
Exactly. It's all about finding that balance.
All right, so we just went through 19 potential financial pitfalls. Anything in particular stand out to you? Maybe something that you've either dodged or maybe even learned from, the hard way?
It's striking to me how interconnected these mistakes can be. One wrong step can lead to another, almost like a financial domino effect.
It's true. It's like you overspend on a vacation and suddenly you're racking up credit card debt and then you have to delay saving for retirement just to make those minimum payments. It can spiral pretty quickly.
Absolutely. It's a chain reaction. And that's why recognizing these common mistakes is so crucial so we can break those cycles and make better choices.
It's about taking control, right? Not letting our finances control us. Now, for me, emotional investing is something I've definitely struggled with. I've let fear or FOMO drive some of my investment decisions in the past.
Oh yeah, it's a common trap. The market can feel like a roller coaster with all those highs and lows. And it's easy to get caught up in the excitement or panic, but that's why having a solid long-term plan and sticking to it, even when things get a little bumpy, is so essential.
It's like having that financial anchor to keep you grounded when the market storms roll in.
Yeah.
Another one that really hit home for me was the importance of having that emergency fund. Life is unpredictable, right?
Yeah.
And being prepared for those unexpected twists and turns can make all the difference.
Absolutely. It's about having a buffer, a financial safety net to catch you when those unexpected expenses pop up, whether it's a job loss or a medical emergency or even a major car repair. Having that emergency fund can prevent those situations from turning into much bigger financial problems.
It's like having that spare tire in the trunk of your car. You might not need it very often, but when you do, you're sure glad you have it. Now, I'm curious about diversification. It seems like such a fundamental principle of investing, but one that can be easy to overlook, especially when you're first starting out.
You're right. Diversification is all about managing risk. It's about spreading your investments across different asset classes, stocks, bonds, maybe some real estate, to cushion your portfolio against those inevitable market fluctuations.
Like the old saying goes, don't put all your eggs in one basket.
Exactly. If one basket falls, you don't lose everything. You've got other baskets to absorb the shock. And while we're on the topic of mitigating risk, let's not forget about insurance. I know, it's not exactly a glamorous topic, but
It's crucial, right? It's like that ultimate safety net for those life events that could have some serious financial consequences.
precisely. Whether it's health insurance, life insurance, disability insurance, or even just good old property insurance, having adequate coverage can provide that essential protection when you need it most.
It's about having that backup plan in place, just in case. Before we move on, I want to circle back to something we touched on earlier, setting financial goals. It's easy to get so caught up in managing our day-to-day finances that we lose sight of the bigger picture, of what we're actually working towards.
You're absolutely right. Having those clear and specific goals gives us a target to aim for, a roadmap for our financial journey. Without them, it's easy to wander aimlessly and never really reach your full financial potential.
It's like setting off on a road trip with no destination in mind. You might enjoy the scenery along the way, but you're not going to end up where you truly want to be.
Exactly. Whether it's saving for a down payment on a home, or planning for an early retirement, or even just funding a dream vacation, having those goals in mind can really motivate you to make those smarter financial choices and stay focused on what really matters.
And even if those goals seem overwhelming or daunting at first, remember, it's about progress, not perfection. Every step you take, even if it's a small one, moves you closer to where you want to be.
You got it. Think of it as building a financial staircase one step at a time. And as we're reflecting on these financial missteps and the strategies to avoid them, it's important to remember that personal finance is a continuous journey. It's not a one-time destination.
It's about consistently learning, adapting, and making informed choices that align with your individual circumstances and goals. And it's okay to make mistakes along the way. What truly matters is learning from those mistakes, adjusting course, and keeping moving forward.
It's a process of growth, right? And financial well-being isn't solely about amassing wealth. It's about having the freedom and the security to create a life that's both meaningful and fulfilling. It's about aligning your financial decisions with your overall life goals and finding that sense of balance and harmony.
Well said. So true. Now, before we wrap up this part of our deep dive, I want to leave you with something to think about. We spent a lot of time talking about how to avoid financial mistakes, but what about actively creating opportunities for growth and abundance?
I love that. Shifting from a defensive mindset to a more proactive approach. Instead of just protecting what we have, how can we actively grow and expand those financial horizons?
Exactly. How do we move beyond simply safeguarding our finances and start creating a life of true abundance? What would that look like for you? That's something I want you to consider as we head into the final part of our deep dive. Okay, so we've uncovered those 19 financial traps, and now let's switch gears. Instead of just playing defense, how about we explore ways to actively create those financial growth opportunities?
I like that. It's like shifting from damage control to building something new, exciting.
Exactly. So instead of just focusing on what not to do, let's talk about how to build that financial engine.
Well, one powerful approach, even if you're not an entrepreneur, is to think of your finances like a business. Think about it. Businesses constantly look for ways to increase revenue, cut costs, streamline operations.
Okay, I see where you're going with this.
Yeah.
So how do we take that business mindset and apply it to our personal finances?
It all starts with recognizing your assets, your skills, knowledge, your network. What can you leverage to generate income streams, beyond your main gig?
So instead of relying on a single paycheck, we're diversifying those income streams, just like we diversify investment.
You got it. Maybe you're a fantastic writer. Could you freelance on the side? Or you're a master organizer. Maybe a virtual assistant business is your calling. There's so many possibilities.
It's about thinking outside the box, beyond the traditional 9 to 5.
Right.
So what else can we do to really create those financial growth opportunities?
Continuous learning is key. The more you know, the more valuable your skills become, and that translates into greater earning potential.
So it's not just working hard, it's about working smarter. What are some ways to invest in ourselves?
So many options. Online courses, industry conferences, even just reading books and articles related to your field. It's all about staying ahead of the game, becoming a sought-after expert in your area.
So basically investing in your human capital. Because ultimately, your ability to earn is your most valuable asset.
Absolutely. And don't underestimate the power of networking. Building relationships, connecting with people in your field, even in related industries. It can unlock unexpected opportunities, collaborations, maybe even mentorship.
It's about expanding your circle and finding those win-win situations.
Right. Now, creating financial opportunities isn't solely about generating more income. It's also about optimizing your spending.
So back to that treat yourself mentality we talked about earlier. Should we just cut it out completely?
Not necessarily. It's more about being strategic, mindful, look at your spending habits. Where can you trim without sacrificing your quality of life?
Yeah, maybe skipping that daily latte a few times a week, or negotiating a better rate on your car insurance, or even your cell phone plan. Lots of possibilities there.
Small expenses add up, right? And don't forget the power of negotiation. Whether it's a raise or haggling for a better price on a car, or even just asking for a discount, don't be afraid to speak up for yourself.
Know your worth.
Exactly. And finally, creating opportunities often involves taking a chance, a calculated risk.
Okay, so not reckless gambling, but...
Definitely not. It's more about stepping outside your comfort zone, exploring new possibilities, being okay with a bit of uncertainty.
So maybe it's starting that side business you've been dreaming about, or investing in rental property, or even making a career change that aligns with your passions.
Sometimes you have to leap to see what you can achieve. And remember, there are no guarantees, but taking calculated risks can lead to incredible rewards, both financially and personally.
I love that. So as we wrap up this deep dive, let's remember to shift that focus from simply avoiding mistakes to actively creating opportunities.
Your financial journey is unique, right? There's no one-size-fits-all approach. It's all about knowing your values, your goals, your risk tolerance, and creating a plan that works for you.
It's about owning your financial future and building a life that you love. So everyone listening, go out there, explore those possibilities, and keep diving deep.